Is investing in stock market is a good decision for you? And what is stock market actually? Hello everyone. I am from Mobile RFI and your financial advisor, and now I am going to reveal the answer of this question: how to make money in stock market. Well, ask any financial expert, and you'll hear stocks are one of the keys to building long term wealth. But the tricky thing with the stock is that while over the years they can grow in value exponentially, their day to day movement is impossible to predict with total accuracy. Which begs the question, how can you make money in stocks? Actually, isn't hard so long for as you adhere the some proven practice and practices with patience. The number one point is buy and hold. There's a common saying among long-term investors: time in the market beats the timing in the market. What does that mean? In short, one common way to make money in stocks is by adopting a buy and hold strategy, where you hold stocks or other securities for a long time instead of engaging in frequent buying and selling. That's important because investors who consistently trade in out of the market on a daily, weekly, or monthly basis tend to miss out on opportunities for strong annual returns. Don't believe it? Consider this: the stock market returned 9.9% annually to those who remained fully invested during the 15 years through 2017. According to Putnam Investments, but if you went in and out of the market, you jeopardized your chances of seeing those returns. For investors who miss just the 10 best ways in that period, their annual return was only 5%. The annual return was just 2% for those who missed the 20 best days. Missing the 30 best days actually resulted in an average loss of 0.4% annually. To be more precise, being out of the market on its best days translates the vastly lower returns. While it might seem like the easy solution to simply always make sure you are invested on those days, it's impossible to predict when they will be, and the days of strong performance sometimes follow days of the large dips. That means you have to stay invested for the long haul to make sure you capture the stock market at its best. Adopting a buy and hold strategy can help you achieve your goal. And what's more, it helps you to it helps you come tax time by qualifying for the lower capital gain taxes. Number 2 point is option for funds over individual stocks. Seasoned investors know that a time-tested investing practice called diversification is key to reducing risk and potentially boosting returns over time. Think of it as the investing equivalent of not pulling all of your eggs in one bucket. Although most investors gravitate toward two investment types, individual stocks or stock funds such as mutual funds or exchange traded funds (ETF), experts basically recommend the latter to maximize your diversification. While you can buy an array of an individual stocks to emulate the diversification you find automatically in the funds, it can take a time, a fair amount of investing savvy, and a sizable cash commitment to that successfully. An individual share of a single stock, for instance, can cost hundreds of dollars. Funds, on the other hand, let you buy exposure to hundreds or thousands of individual investments with a single share. While everyone wants to throw all of their money into the next Apple or Tesla, the simple fact is that most investors, including the professionals, don't have a strong track record of predicting which companies will deliver outsized returns. That's why experts recommend most people to invest in funds that passively track major indexes like the S&P 500 or Nasdaq. The positions you benefit from the approximate 10% average annual returns of the stocks market as easily as possible. Next, I'm going to suggest you to reinvest your dividends. Many businesses pay their shareholders a dividend, a periodic payment based on their earnings. While the small accounts you get paid in dividends may seem negligible, especially when you first start investing, they are responsible for a large portion of the stock market historic growth. From September 1921 through September 2021, the S&P 500 saw average annual returns of 6.7%. When dividends were reinvested, however, the percentage jumped to almost 11%. Oh my god. That's because each dividend you reinvest buys more of your shares, which helps your earnings compound even more faster. That enhanced compound is why many financial advisors recommend long-term investors reinvest their dividends rather than spending them when they receive the payments. Most brokerage companies give you the option to reinvest your dividend automatically by signing up for a dividend reinvestment program or DRIP. Next, I'd like to recommend you guys to choose the right investment account. Though the specific investment you pick are undeniably important in long-term investing success, the account you choose to hold them in is also crucial. That's because some investment accounts give you the benefit of certain tax advantages like tax deduction, now traditional retirement accounts or tax-free withdrawals, ROTH. Whichever you choose, both also let you avoid paying taxes on any gains or income you receive while the money is held in the account. This can change your retirement funds as you can defer taxes on these positive returns for decades. This benefit comes at a cost, though you generally can't withdraw from retirement accounts like 401k case or individual retirement accounts IRS before age 59 without paying a 10% penalty as well as taxes you owe. Of course, there are certain circumstances like burdensome medical cost or dealing with the economic fallout of the COVID-19 pandemic that led to tap into the money early penalty free. But the general rule of thumb is once you put your money into a tax advantaged retirement account, you shouldn't touch it until you have reached retirement age. Meanwhile, plain or taxable investment account don't offer the same tax investment but do let you take your money whenever you want for whatever purpose. This lets you may take advantage of certain strategies like tax loss harvesting that involve you turning your losing stocks into winners by selling them at a loss and getting a tax break on some of your gains. You can also contribute an unlimited amount of money to taxable accounts in a year. For 401ks and IRS have annual caps. All of this is to say, you need to invest in the right accounts to optimize your returns. Taxable accounts may be good, place to park your investment that typically lose less of their returns to taxes or for money that you need in the next few years or decade. Conversely, investment with the potential to lose more of their returns to taxes or loss that you plan to hold for a very long time may be better suited for tax advantages accounts. Most brokerages, but not all, offer both types of investment accounts. So make sure your company of choices has the account types you need. If yours doesn't, or you are just starting your investing journey, check out any extraordinary list of the best brokerage of the world to find the right choice for you. To make money investing in stocks, just stay invested. More time is more time equals more opportunity for your investment to go up. The best companies tend to increase their profits over time, and investors reward these greater earnings with a higher stock price. That higher price translates into a return for investors who own the stock. But first thing first, you'll need a brokerage account you can start where you can before you can start your investing. More time in the market allows you to collect dividends if the company pays them. If more trading in and out of the market on a daily, weekly, or monthly basis, you can kiss these dividends goodbye because you likely own the stock at the critical points on the calendars to capture the payouts. The longer you are in, the closer you will get to the historical average annual return of 10%. But you know what? There are few excuses that keep you from that are refusing you or not allowing you to make money by investing. Now I'm gonna reveal 3 excuses that keep you from making money with investing at stock market. The stock market is the only market where the goods on the goods sale and everyone becomes too afraid to buy. That may sound silly, but it's exactly what happens when the market dips even a few percent. As if it often does, investors become scared and sell in a panic. Yet, when prices rise, investors plunge in headlong. It's a perfect recipe for buying high and selling low. To avoid both of these extremes, investors have to understand the typical lies that tell themselves. Here are 3 of the biggest. Number 1, I'll wait until the stock market is safe to invest. This excuse is used by investors after stock have been declined. When they are too afraid to buy into the market, maybe stocks have been declining a few days in a row, or perhaps they've been on a long-term decline. But when investors say they are waiting for it to be safe, they mean they are waiting for prices to climb. So waiting for the perception of safety is just a way to end up paying higher prices, and indeed it is often merely a perception of safety that investors are paying for. What drives this behavior? Fear, this gilding emotion, but psychologists call this more specific behavior loss aversion. That is, investors would rather avoid a short-term loss at any cost than achieve a longer-term gain. So when you feel pain at losing money, you likely to do anything to stop that hurt. So you sell stocks or don't even buy when prices are cheap. And then second excuse is I'll buy back in next week when it's lower. This excuse is used by would-be buyers as they wait for the stock to drop. But as the data from the Putnam Investments shows, investors never know which way stocks will move on any given day, especially in the short term. A stock market or market could just easily rise as fall next week. Smart investors buy stocks when they are really cheap and hold them over time. What drives this behavior? It could be fear or greed, or no. The fearful investors may worry the stock is going to fall before next week and waits, while the greedy investors expect a fall but wants to try to get a much better price than today's. Another excuse is I'm bored of this stock, so I'm selling. This excuse is used by investors who need excitement from their investments, like action in a casino, but smart investing is actually boring. The best investors sit on their stocks for years and years, letting them compound gains. Investing is not a quick hit game. Usually, all the gains come while you wait, not while you are trading in. This desire may be fueled by the misguided notion that successful investors are trading every day to earn big gains. While some traders do successfully do this, even they are ruthlessly and rationally focused on the outcome. For them, it's not about excitement but rather making money. So they avoid emotional decision making. Now, what you have decided? Index funds or individual stocks? If that 10% annual return sounds good to you, then the place to invest in an index fund. Index funds comprises dozens or even hundreds of stocks that minor an index such as S&P 500. So you need little knowledge about the individual companies to succeed. The main driver of success again is the discipline to stay invested. Yes, you potentially can earn much bigger returns in individual stocks than in an index fund, but you will need to put some sweat into researching companies to earn it.